My name is Alan Breen, Senior Investment Manager with Cantor Fitzgerald Ireland. Welcome to today's market update. I'm delighted to be joined by Phil Byrne, Head of Equity Investments for Merrion Investment Managers, who's with me to talk us through where we're at currently, and more importantly, where do we go from here? Phil, how are you? It's been a tumultuous start to 2022, and it's also involved significant underperformance as well by the MIM funds. Perhaps you could set the scene on where we're at and why we are where we're at and where we go from here.
Hi, Alan. Yeah, as you said, it's been one of the worst starts on record for both equity and bond markets, with global indices down anywhere between 10 and 20%. Similarly, global bond markets also generating negative returns of between 10 and 20% year to date. There's three reasons for why we've seen such volatility. The first reason, and the most important one, has been the extreme policy pivot we've seen from the Federal Reserve in the US. As we approached Q4 last year, the market had anticipated next to no interest rate hikes this year, believing the inflation problem that we had was transitory and would prove to dissipate as quickly as it came. Unfortunately, by October, November, that appeared not to be the case. Not only was it stickier, it accelerated. It became quite a political issue in the US, and it kickstarted a change in policy from the Federal Reserve, the speed of which we haven't seen since the 1970s. So essentially, in a 3 or 4 month period from November to February this year, the market went from pricing in 0 rate hikes from the Fed to trying to price in almost 11 or 12 actual rate hikes. To put that in context for people, in the last rate hiking cycle, and from 2015 to late 2018, so over a 3.5-year period, the Fed hiked about 10 times. And this time the market was trying to price that the Fed would do that over a 1-year period. From then, we had then 2 black swan events. Everyone's aware of, obviously, the tragedy in Ukraine and the dislocation that caused, particularly in commodity markets, both energy and agricultural commodities. That exacerbated the inflation problem we had and added to risk appetite, decreased risk appetite even further. And then more recently, in late April, we rather surprisingly had another lockdown in China on the back of COVID. Although the West is very much through its COVID crisis, we saw a very small number of cases in China, which caused them actually to lock down 25% of their economy, and in particularly Beijing and Shanghai. And also that also exacerbated the inflationary fears people had, believing that it would disrupt the already disrupted global supply chains.
No, I was going to say it had been well flagged in the market, and the Fed had been the key catalyst a couple of weeks ago when we had the recent meeting. Were you surprised at the aggression in the sell-off? Because generally we've been positioned more positively. The frequent updates we've seen have been more constructive than not. Why in particular do you think the market reacted so aggressively to the most recent Federal Reserve meeting?
Yeah, so we think the initial sell-off in Q1, which was, as I said, on the back of the Fed policy pivot, we weren't too surprised about. Unfortunately, we underperformed during that period, hadn't been positioned for this pivot for most of Q4 last year. Ironically, we threw the towel in on that view as it hadn't materialized. And unfortunately, in Q1, it eventually did happen. It happened later than we thought it would, and it was a lot quicker and sharper. So that was responsible really for a lot of the underperformance in the first quarter. From then, though, markets had by and large settled down. And actually, since the start of April, the expectations for Fed policy have actually improved at the margin. Inflation is showing signs of slowing down, and we've begun to take rate hikes out of the market. In spite of that, the last 2 weeks of April and the first week in May saw some of the biggest and quickest declines in markets we've seen in 20 or 30 years. So some context, the NASDAQ in Q1 actually only ended down 7%, whereas that 3-week period we've just gone through saw declines of closer to 20 or 25%. Although the market narrative has been that is on the back of central bank policy, we think it was more on the back of the unexpected lockdowns in China. And after having such a bad start to the year, it was effectively the straw that broke the camel's back for the market. A lot of investors, particularly in the US and anyone exposed to US technology stocks, was having a bad year, and this volatility just added to more forced de-risking.
Phil, we might just touch on the risk management side of the funds. If you look at what's happened in markets, you've had a complete breakdown in the correlation as well between equities and bonds. So there really hasn't been a significant amount of a safe haven per se. I mean, if investors look at the Merrion funds, we have the 70, the 50, 30, which each have their own risk categories. Yet, you know, the MIM 30, for example, which will be the lower risk of the funds, is down 12% year to date. So I guess my question is, was that a key determinant of that, I guess, the breakdown of the normalization between, say, bond markets and equities? Effectively, everything got hit in the last number of weeks.
Yeah, exactly. So we've had our portfolios, as anyone knows, are split between defensive assets and growth assets. So, for example, we take the Merrion 50 fund would usually 50% be invested in growth assets, which is things like equities and property, and 50% in defensive assets, which is things like bonds and corporate bonds. This year we had a very unusual situation where both bonds and equities not only sold off together, but both had their worst start to the year in 20 years, which meant a combined bond and equity portfolio has actually had its worst start to the year in 50 years, since 1972. Traditionally, when we get events like a war in Ukraine or a Chinese lockdown, you'd expect the equity portfolio to underperform and to sell off, but you would expect the bond portfolio to actually go up and to provide a buffer. So this year, unfortunately, it didn't do that. Although I would say the bond portfolio relative to benchmarks has outperformed. We were underweight bonds at the start of the year. We were aware of the threat of the Fed rising, but the magnitude and the speed of the moves means the absolute number is down, and it hasn't protected the portfolio. Also, within that, what we've owned in growth assets, and in particular the equities and the sector exposures we have, you know, which have benefited us so much over the last 3 or 4 years, have really suffered in this drawdown. As particularly in the last 3 weeks, our exposure to US technology names and US growth names in particular have really suffered. A lot, again, similar to bonds, a lot of these companies are some of the highest quality companies in the world. And during shocks like we've had in the last 5 years, Brexit, COVID, Trump election, they've always outperformed as people have gone to look for the companies with the strongest balance sheets, the strongest margins, the strongest return on capitals. Again, in the last 3 or 4 weeks, that hasn't worked at all, as it's more been a forced liquidation across the board.
I mean, in fairness, we have seen a number of global hedge funds literally blow up in the last number of weeks. Perhaps you could just, you know, give us a little bit more color again on some of the risk management tools you have at your disposal. And I suppose, despite everything we've gone through, more importantly, where do you figure now? Are you still maintaining that more constructive view, medium to longer term?
Yeah, I think like one of the benefits of running a multi-asset portfolio is that you have the option to invest in a suite of assets. And as I said, historically, the main buffer has always been the bond equity correlations, and that have helped. That's broken down this year. We were invested at the start of the year in copper, oil, and energy stocks, which has helped somewhat on the rally. Another way where we've traditionally protected the portfolio is through buying index options, so-called put protection or insurance, as people would say, to protect the portfolio on these downdrafts. This year, although we have purchased quite a lot of index protections and puts, it hasn't worked for us both through some short-term timing we've got wrong, that the market's been volatile. We've been a couple of times paid for protection, and then the market would rally over the next 2 or 3 weeks, and that protection would roll off, and then it would sell off again, which has cost us. And because the market's been so volatile, the price of that protection is so high that it's very difficult to make money. A very simple analogy I would use, it's like, you know, if you try and buy car insurance the day after you've crashed your car, or you're trying to buy house insurance the day after you've had a fire, the cost of it has gone through the roof, so it doesn't make sense. So that also hasn't helped us, which would traditionally have helped us. During the war in Ukraine, and around that time, we performed relatively quite well. We were able to hedge our European exposure through selling European banks and buying some DAX puts. So over that particular period, that sort of one-off risk event, we were able to dissipate some of the losses. But in general, and particularly in the last 2 or 3 weeks, we haven't been able to offset the losses.
And Phil, I suppose, moving on and where we're at, there are a number of positives in the market as well. I guess the recent difficult period, is this a time to be selling? Is this a time to be cutting and running, or do you see opportunity? We've come through earnings season as well. So now that the recent Federal Reserve meeting is out of the way, where do you currently sit and how are you positioned?
Yeah, so as anyone who listens to us in our webinars know, we have a 3-pillar investment process where we look at the world from a top-down perspective, a bottom-up perspective, and from the market's perspective, a technical perspective. So during the huge bouts of volatility, like we've seen in the last 3 or 4 weeks, that's what we try and fall back on, to try and take the emotion out of the markets and out of performance and see what all our indicators are telling us. And what we can see in the last 2 or 3 weeks is that this last bit, for the way we look at the world, is just an overcorrection on the Fed's tightening policy. We see, and ironically, when we look at the world from the top down, as I said, like from a macro perspective, we think we're at peak inflation. We can point to numerous indicators that were lead indicators for inflation to increase that are now rolling over. So if we're at peak inflation, we're then at the peak policy from central banks. And this is what's caused all the issues. And I would use an analogy of this is similar to what happened in late 2018 when the Federal Reserve, they got their rates similar to where they are now. And that was the end of the tightening policy because they saw enough both softness in the labor market and the economy. They didn't need to tighten anymore. So we think if we're right on that, then that's generally quite a good time to invest in risk assets and in equities in particular. And then also when we look at the volatility in the last 3 weeks, the de-risking that it's caused is really quite spectacular. If you think equities in general have had 3 phenomenal years of plus 20% in a row, this recent drawdown has caused people to position themselves exactly where they were positioned in times like March 2020, when we had COVID, in October 08, when we were in the middle of the financial crisis, June 2012, when we were at the peak of the European sovereign crisis, and actually cash levels in the market, so the amount of selling we've seen last 3 weeks, is now back to what people did post September the 11th. So these are just ginormous events in history, and we can't see the analogy or the similarities between them all. For now, we can accept the Fed have tightened, maybe they've over tightened, but this is something that the markets can get through, and we're still in a very low interest rate world. And then when we look at, so not only the positioning in equities, but for all the sell-offs that we've seen and for all the inflation scares, markets are still growing earnings. They're still growing earnings better than expected. They're still at peak margins. They've still got the best balance sheets ever. So they've got no leverage, there's little to no leverage in the market compared to what we saw in, say, 2000 or 2008. And most importantly as well, just all the important long-term trends that have driven both the stock market and the economy over the last 10 years are still by and large intact. Anything from digitalization, decarbonization, and we've even seen now a huge increase in the likes of defense spending in Europe. I can't think of anyone, but just sorry, I've lost my train of thought there. But they're just all the positive trends we've seen.
Yeah.
Sorry, deglobalization. That's the fourth one. I know of people, coming back. So for all the threats, say something like the supply chain issues we've had over the last number of years post-COVID, that's caused a huge surge in investment in the West. We're now building factories in Europe and the US to make our own batteries, to make our own semiconductors, to manufacture much more important elements of the supply chain closer to home.
And where, Phil, do you see, or how are you guys positioned currently? What kind of names would you hold, or where do you see real opportunity? You mentioned in the outset the big tech names in particular have been smashed, yet they're multi-year growth stories, structural winners. Would you be buying in these levels, or does it form part of your overall positioning?
Yeah, so we added to our exposures last week, where the funds are now up at the upper end of their asset allocation ranges. So the 70 fund will be up at 80%. We see opportunity across the board. So there has been, as I said, a huge derating in large cap, mega cap technology names. There's even been, though, a huge sell-off in just traditional cyclicals, because the fear now has gone from inflation to recession. So even banks in Europe and the US, despite rates going up, actually in the last 6 weeks have sold off very much. We look at JP Morgan on 9 times earnings and European banks on 6 times earnings. They don't really go much lower than that. And also, we think although the economy will slow, it has to slow. There's nothing on the horizon that worries us from that slowdown, and particularly banks are as strong as they've ever been. They haven't lent really over the last 10 years. So even if we do get a slowdown from here, we're highly unlikely to see a bad debt cycle or anything like that we've historically seen. So our portfolio anyway is positioned, really I'd describe it kind of long US tech names and US growth names, and European cyclical names like European banks and autos and industrials.
And Phil, what would you see as the biggest risks to your investment view going forward, medium and probably more longer term as well?
Yeah, so the biggest risk will continue to be central bank policies and inflation. So over the next 3, 4, 5 months, we have to keep almost a daily eye on every reading data point we can get about inflation that's coming through, just to make sure that it has peaked. The Fed have told us what their policy is going to be between now and September. So we have a bit of a clear run between now and then to see that through. So that's the first aspect we need to keep an eye on. The second aspect we need to keep an eye on is just, we're seeing a slight change in behavior from the large cap corporates, particularly in the US, on the back of this dramatic sell-off. So at the moment, we've seen, and even in the last few weeks, Walmart, Facebook, Amazon, all talking about a hiring freeze. They've all actually admitted they effectively overhired as we reopened in the economy. So, they're being a bit more cautious with their expansionary plans. This is positive in the short term. We just have to make sure that if by the end of the year, a hiring freeze doesn't become a layoff cycle, and then if a layoff cycle, they start cutting back on their CapEx, because that's been what's driven so much growth in the economy over the last 10 years. So that's kind of what we're really looking at for the longer term. And a lot of it is a function of they're shocked really by how poor their share prices have been. So it is changing their behavior a bit. At the moment, the behavior, it's good what they're doing, but if things don't improve, it can just become a self-fulfilling prophecy and get worse.
So I guess to conclude, we've had an overreaction from markets. They've corrected aggressively into the Fed pivot policy, resulting in a surge in volatility. Throw into the mix the horrific situation in Ukraine, lockdowns in China, the depreciation of the yen as well, the Chinese devaluation, and a number of high-profile hedge funds having extreme difficulties as well, and in fact blowing up as well. It's been a pretty dramatic start to 2022. But I guess right here, right now, would it be fair to say you see opportunity currently?
Yeah, that's it. Like, we have an investment process. It's stood to us over the last 3-5 years, and we are willing just to follow it through from now. And what we can see now is more opportunities than threats. And historically, post these levels of drawdown, of poor positioning in the market, and in particular, if we're right and we're at peak policy hawkishness from the Fed, these have all historically offered above average returns on both the near term and the medium term. And so for that, that's why we're sticking with our views and our positions for now.
Philip Byrne, Head of Equity Investments for Merrion Investment Managers, thank you.
Thanks, Alan.
Thank you for joining us for today's markets update. If you have any further questions, please do not hesitate to contact your portfolio manager for further details.